Meet the Investments. I am joined here by Chairman and Founder of Ironton Capital, Lon Welsh. How you doing, Lon?
Fantastic. Thanks for having me.
Yeah, well, you're the key piece here. So really appreciate you all being here. There is a chat box on the right-hand side. Feel free to send over your questions, comments as they come in. We'll kick the slide deck off with some routine stuff that a lot of you may have already seen, and then we'll get into the nuts and bolts of each investment here. So we got a really strong diversified fund, potentially one of our strongest diversified funds yet, just from a standpoint of the geography, asset class, etc.
Well, but for diversification, it's our best by far.
Yeah,
it's really
so
strong.
really excited to present all this to you guys. So before we jump into it, quick note from our attorney. This slide emphasizes key legal disclaimers, including that the presentation is confidential and intended solely for evaluating the proposed investment with no sharing or disclosure permitted. It goes on to highlight that the investments in the fund are speculative, illiquid, and involve high risks suitable only for financially sophisticated and accredited investors. You'll see forward-looking statements that are based on current expectations, but carry significant uncertainties and may not reflect actual outcomes. Additionally, the information provided is sourced internally, presented as is, encouraging investors to perform their own due diligence and consult professional advisors before making any investment decisions. So a quick overview of Ironton Capital and our flagship funds. So you're on the National Diversified Fund 9, whether you're already an investor or you're considering investing with us. This will be a great learning opportunity, especially if you're new and on this for the first time. So you can really categorize our funds and our offerings across 4 different solutions. So we have our National Diversified Fund, which you'll learn about today. We've got our 2 income funds. We have a short-term option that has higher liquidity and returns about 8 to 9% a year. It's invested in a hard money loan fund and has a component of medical receivables, which leads me to the medium-term income fund. This fund returns about 11 to 13% a year, depending on your assets under management with Ironton Capital and across all our funds. That also pays quarterly dividends. The only caveat to this fund is you can access the principal once the 1-year lockup of your capital does end. That is not the case with the short-term income fund. And then every so often, we have single asset funds that we've launched in the past and that we'll continue to launch in the future as they come up. So what does your role as a limited partner look like? What does our role as a GP look like? And who do we invest in? So this breaks down and highlights all the various tasks and responsibilities that our sponsors endure and that we go through as well, being operators of the fund. You as a limited partner, it is your priority to choose the fund, do your due diligence, read the quarterly reports, decide your investment size, and then from there, you just hit the easy button, investing with us. But on the left-hand sides here, there's a lot that we do as a GP. So we're constantly monitoring national, local markets, identifying opportunities across the nation. Our investment committee is constantly underwriting deals, vetting deals, deciding what we want to allocate your capital to. So there's a ton of upfront work and work throughout the entire life cycle of the fund that goes into doing what we do. But most importantly, we love doing what we do. And we really appreciate all your trust and consideration in partnering with us at Ironton Capital. Quick overview of the investment team. Brent Geyer on the left-hand side. Brent's our CEO. He's got a ton of experience in corporate finance. He's held a lot of higher up positions at various companies. And he's got about 15 to 25 years of real estate acquisition, development, and then owning and managing his own rental portfolio as well. So just a wealth of knowledge and an incredible asset at Ironton Capital. We got Richard Landry. Richard has a lot of experience. He was formerly the CIO of a $2 billion family office. He's got a lot of experience in working on Wall Street. And he is a key player in the underwriting and the financial modeling of everything that passes through Ironton Capital's hands from an investment standpoint. And well, I've got you on the call, Lon. So if you want to run through this, you're welcome to do so. Why don't you take a couple seconds here and
I worked in corporate finance for a couple of years before going to business school, and then worked as a strategy consultant for 8 years at Deloitte and Accenture. And then I've been in commercial real estate for a couple decades. I've been a developer and I've been a landlord. mostly on value add projects for that whole time. And then I built a real estate brokerage called Your Castle Real Estate from scratch to about 750 agents. And I sold that to a private equity fund in about December of 21. And I'm on the board of directors of a couple of nice charities here in town. So I'm very grateful to have a well-diversified list of things to keep me busy every day.
Excellent. Here's some information on our accounting, tax, and audit support. So we've been working with Michael Coglianese and his team for just over a year now, I believe, right, Lon? So they've got
a little bit more, yeah.
Yeah, so they've got a ton of experience working with companies just like us, other private equity entities, securities, futures, hedge fund companies. They are highly experienced and involved in the industry. So really grateful to have them as partners. So quick executive summary of NDF9. So we are expecting an IRR of about 17 to 20% for this fund over 4 to 6 years. As a reminder, there is no liquidity to this investment. So your money is locked up until a monetization event occurs with one of the investments. So whenever we sell or distribute cash flow or are able to refinance properties. So it's very important that you have the mindset going into an investment like this, that you might not see your money for 5 to 6 years. It's likely that you'll be getting capital back much sooner than that, but it's really important to set that expectation ahead of time in case, we continue on this path in the economy and things don't turn around like we might expect. So have that in mind. From a tax advantage standpoint, there's an option for accelerated depreciation. So we concentrate all the depreciation to our share of Class B. So if you are somebody that is needing to capture depreciation in our fund, maybe you're offsetting other passive real estate gains or other past gains that qualify as passive, then that could be a good option for you. Lon, is my voice coming in okay? I saw Mark's comment here. Oh, okay.
Well, it's perfect, actually. I've got a really clear connection on my side, at least.
Beautiful. So our MO is diversification. We've gone through this. We've discussed the 4 pillars of diversification that Ironton Capital models all of our funds on. And this outlines what we're looking at for NDF9. So from a geographical standpoint, your capital will be deployed across 21 individual states, probably one of our highest diversified.
Oh, it is by far. Yeah, I think our best before this was 12 states.
Yeah, so 12 states being our best up until this point. Now we're at 21 plus states. From an asset class standpoint, we're in multifamily, an industrial warehouse, residential. A lot of you have seen the residential townhome projects we're involved in, some in Denver, some out of Denver. And what's new to this list that we haven't really taken any part of is being in the distressed secondary credit opportunity. So really excited to go into that with you. From a strategy standpoint, opportunistic, value add, and new build. So excited to add that third tier of strategy diversification there. And then sponsor. Again, probably one of our records for NDF here. We're working with 13 individual sponsors. When you break down the individual investments and 13 investments, your capital will be deployed across 40 plus individual buildings. So again, just reiterating how strong of a diversified fund NDF9 has become.
A couple of questions. If you want to take a second, we can try to tackle.
I'll tell you what. Let me run through this before I turn it over.
Yeah, of course. Yeah, we can do that.
We'll address Darren's question. So a lot of you asked for our Ironton Capital track record. This helps summarize and lay it out. So on the bottom side, or on the bottom part of this slide, you'll see our short-term income funds 1 and 2, and then the medium-term income funds 1 and 2. All 4 of these funds continue to perform right within the range that we expect. And so a lot of you on this call are probably in one of those funds and can attest to that. So we're really excited and very pleased with how those funds are operating and continue to perform. And then we've got National Diversifieds 1 all the way through what you're seeing here, NDF9. So our most complete fund thus far is NDF1. We're tracking to about a 14% IRR. 5 of those 8 investments have been sold. I'm sure we anticipate the remaining 3, Lon, probably to be sold in the next year or 2, I would imagine. And then we'll have a full
2 years.
Yeah,
2 years at the most. The projects are done. We're just waiting for a good time to sell them, which actually feeds into one of the questions we've got here.
Yeah, fantastic. So you can see a lot of the funds that we have, and based on their current performance to date, they're right in line with what we've been targeting. So really excited to continue to return capital to you investors. I think 2025 will be a great year for some of these funds. 2026 will probably be even better, but we're making really good progress with a lot of the funds and the individual investments in each. So I will stop there, and then Lon, I'll turn it over to you on the next slide. But let's let's address Darren's question here. So he says, from a timing standpoint, when you say 4 to 6 years, is that market dependent? In other words, should the market decline and in an effort to try to achieve 17 to 20% returns, and there's a handful of years for a turnaround, could the fund go longer? And would it be for the sole purpose of trying to recover those expected yields?
Yep. So for example, in NDF1, we were lucky enough to get a couple of these done before things slowed down in the summer of 2022. So they sold kind of a little bit faster than planned. And then 23 and 24 have been sort of not that great of a time to be selling investment properties. So the 3 remaining projects in Fund 1, they're done. The renovation is done. The rents are in place. We've got the track record. We're just waiting for the market to thaw out so we can get a slightly better price. So the guys will be really good beneficiaries of this. If you take a look at like Fund 5, which was 2022, those projects are going to be all maturing probably in 25 and 26, like 3 or 4 years into it, which is probably going to be a really strong time to be selling properties. So we coached, the investors in Fund 5 that was to be a 5 to 6 year fund. In reality, most of those things will probably sell by the end of the 3rd year, and we'll have a couple stragglers to year 4, but it won't be a lot. So every fund is going to be a little shorter or a little longer depending on the macro environment that we find ourselves in. So I try to set expectations as low as I possibly can get away with, so we've got more room to have that flexibility and not disappoint anybody.
Excellent. And then Kurt's question is, it seems like your team has changed from previous NDF funds. Is there a reason for that? And I assume there's a benefit for having greater diversity in locations. Yeah,
really the main change is on the investment committee. So Richard has been with us for a couple of years, and then Vital left the investment committee. He just had a milestone birthday and wanted to work a little bit less. So he's still helping us out on the income fund side, but just, didn't want to work as many hours. And then Richard, we thought would be a great fit for the investment committee. So that's why we made the swap there. But amazingly enough, there's 4 of us full time just looking at deals all day long. It just takes a lot more time than I thought it would ever to get it done. And then the diversity in locations is really driven by a couple projects, partially Hill Point, partially the NPL fund, which will be in a couple states. And those are the 2 main ones. Kurt, it wasn't like we went out intentionally seeking more diversity in geographic locations. It's just that we happened to get lucky enough to find some that were scattered at still met all the criteria. So this will probably end up being the high water mark. I doubt that we'll have another fund that has as many locations as this one. And then Roger, if you're in this fund, so the good news and bad news is we do a lot of the tax paperwork for you. We wait until we get all of the K1s on each of the 13 investments. Our CPA team consolidates them all, does any state filings that are required on behalf of all of us in the fund. So then you just get one consolidated return on the back end. So that's all good news. Bad news is that I've got to wait till every camel in the caravan arrives before we can consolidate the statements. And inevitably, whatever the last day is, at 3 o'clock is when I get like the last statement. So you're going to have a slower tax filing process, but the good news is that it won't be laborious for your accountant to process it.
Yeah, and to piggyback on that as well, because Roger was asking a bit about the beneficial ownership filing. I would go directly to your CPA, which is I think recently a Texas court judge basically blocked the beneficial ownership filing from happening. But I would go to your CPA. I think they can give you hopefully a lot more information than we might be able to give you here live.
Good answer for that. So here's a quick overview of the different projects, and we're going to go through every one of these, but this is just a great summary. The longest projects on here are the first one, Hill Point, and the second to last, DC Flats. Those could potentially run 6 years. We've actually got a fair number of these that are in the 3-year range, and actually one that could be 2 years. So on average, this fund might run a little bit faster than some of our prior funds, which is pretty exciting, particularly because I do think that 2026 is probably going to be a really good year for selling, and probably 27 will be as well. So the timing for cash flows, I wouldn't anticipate any cash coming back next year. a little bit of refinance activity in 26. You'll probably get almost all of your capital back in 27, and the profits will come in a couple of years after that. The shape of this curve is pretty similar to what we've had on our prior funds. So the first project in here is Hill Point. So if you've been on any of our calls before, you've heard me talk about Hill Point. It's one of my most favorite sponsors of all time. So they build workforce housing. So the way to think about that is if you've got high-end luxury on one end and tax support for economically disadvantaged people on the other side, there's this continuum. Workforce is right in the middle. So there's no tax subsidies or government subsidies. There's people paying their own rent, but they're just normal people. People who drive the ambulance or your teacher or your firefighter. They need a nice place to live, but they don't want to spend a ton on rent because they're not making a ton of money. So most of these working citizens end up in a 30 or 40-year-old apartment product that hasn't been well maintained, doesn't have a lot of amenities. So the goal for Hill Point is to build clean, nice, dependable workforce housing without a lot of frills, but it's in a good location, it's safe, and it's got all the things that you need to have, but it's a new product. So there's a very eager audience to take over the rental of this type of product. We've invested in quite a few of their earlier funds. So historically, they've worked in Florida, Georgia, and South Carolina. They're going to be adding Arizona, Texas, and Tennessee. So slightly bigger footprint. But other than that, Hill Point 5 will be the exact same strategy as Hill Point 4 and Hill Point 3 that we've invested in the past. I'm putting in here the expectations that the sponsor gave to me for a 6 or 7 year hold. It'll probably be a little faster than that. The 17 IRR is based on what we hear from the sponsor. Fund 4 is shaping up to probably do better than that. Their earlier funds did a lot better than that. We'll probably allocate $1 or $2 million to this strategy, depending on how much we raise overall in the fund. Your one investment in Hill Point 5 will be building somewhere between 20 and 24 different apartment communities at different locations, each of them around 300 units. So we get a lot of geographic diversity, 6 states, and a lot of complexes, at least 20, just from this one investment. So we're really pleased with them. One of the things that's been very exciting to see recently in Hill Point 3 and Hill Point 4, earlier versions of the exact same strategy of this fund, is that they've identified a few banking partners that once the construction is complete and they start the lease up, when they get to about 30% occupancy and they've really proven out what the rents are going to be, they've been able to start successfully refinancing the projects then. Historically, you'd have to get to 90% occupancy, get 6 or 12 months of run rate, and then refinance. So this new banking set of relationships allows us to refinance 12 to as much as 18 months faster than historically you would expect with this asset class. So what that means to you is that we might be able to return as much as 70 to 75% of our capital that we deploy to Hill Point could come back to us within a 2 to 3 year period. We might need more time than that to realize the profits, but if I can get the initial capital back to you pretty rapidly, it really helps the rate of return numbers quite a bit. And everyone's always pleased when they get capital back anyway. So they intend to keep on that strategy. Another thing that I think is really encouraging is take a look at Hill Point 4. That fund is just over 2 years into its life cycle. They've got 21 communities in it. 4 of the 21 communities are already complete and midway through the leasing cycle after only 24 to 27 months. So they're very fast getting the initial ones out the pipe. So a few of those will probably be candidates for refinance soon. So if we see something similar with Hill Point 5, no reason to think that there won't. It'll be very good financially, a lot better than the 17 that I've got here. So here's some photos. This is from Hill Point 3, but they have the exact same floor plan, exact same finishes in mind for Hill Point 5. So what you see here will be very, very close to what will get delivered for our fund. And although it is, an affordable price point for workforce housing, you still see we've got quartz countertops, upgraded stainless steel appliances, lots and lots of cabinets, lots of storage. If you take a look at the upper right at that bathroom, there's a lot of storage in there. 9-foot ceilings, the luxury vinyl tile floors. It's a really nice product. So the outside of this, built to be bulletproof, low maintenance. That's a concrete impregnated board on the outside. It's got like a 50-year warranty, so very low maintenance. It has a fitness center, it has a pool, it has cabanas, it has a clubhouse, not as ornate as our luxury products, but more than enough. And for people in workforce housing, like your school teachers and ambulance drivers, that are otherwise going to be in a 30-year-old product that hasn't been renovated and probably doesn't even have these amenities, this is just obvious. So we're really excited to be participating in this. So Darren's asking, upon the maturation of the fund, is the capital returned all at once or is it in phases? It'll be in phases. So if you take a look, let's pretend, Darren, just to make math easy for us, that we raised $10 million on the nose and we made 10 investments, not 13, and that we put an equal amount into each investment, so $1 million each. As each fund investment completes or refinances, we'll return that capital to you probably within 45 to 60 days of when we get it. We won't hold it for very long, just for like accounting. So, in this case, like what you might find is that the single track residence wraps up entirely in, say, 24 months, and you get all of your $1 million capital investment back plus, say, $450,000 of profit. And then at 30 months, maybe the New Jersey townhomes wrap up and you get that $1 million of initial capital, and maybe they've got $520,000 of profit on top of it. But Hill Point, might still be 2 or 3 years away, for example. But we'll return the cash as soon as we get it, and we don't reinvest any of it. We just send it back to you. Great question. So PFD is our sponsor for the medium-term income fund. It's a medical receivables. So we'll have a little more cash that we'll raise from you than we will invest. And instead of just having that sitting at Chase Bank making 1% interest, we'll invest it at PFD and get something like 13% interest. So if we have a capital call from any of our sponsors in the first year or two, we'll have a couple $100,000 on hand to be able to make that capital call without having to bother you guys to write a check. If there aren't any capital calls, we've got a 2% annual management fee that's due each year. So rather than pestering you to send in the money for the asset management fee, we'll just take it out of that account. So that's what this is here for. And a lot of you guys are invested in MTI, so you're already very familiar with the strategy. So Spring Forest is an apartment complex in North Carolina, and it's, I believe this is Raleigh-Durham, yes, which is a great market to be in. And we were able to buy this relatively new complex from 2002 at a pretty attractive price. We think that we'll probably be able to get some depreciation from the cost segregation study that we'll do, and it's a relatively light value add. We just had a seller that had to sell, and we were able to help coordinate a relatively fast closing to get an attractive price on this asset. So most of you on the call are real estate investors who've probably been in similar situations with homes, just exact same strategy. So this is a nice low risk, decent return. It's a really solid base hit. I'm very excited about that one. So here's some pictures of the complex as it is today. So you can see it's pretty nice. So Zero New Boston, I have invested with this is Cabot and Forbes is the sponsor. I invested with them on a prior project, also in Boston, where this one is at. And this is a really great project that they knew would be oversubscribed. So what they did is they sent an email out to their prior investors and said, we've got this project, would you like to invest in it? And me plus that group, we fully took all the equity of this project. It never got exposed to the public at all. So I'm just really grateful I got to be part of it. I'm disappointed. I would have put about $500,000 into this had I been allowed to, but there was more demand from the prior investors than they needed to raise. So our allocation was $150,000. So this is a new apartment complex. So let me show you this. So if you're in Boston, two of the major arteries are Interstate 93 and Interstate 95, and where they meet, that is where we're located. So I think it's 0.8 miles off of one of those interstate exits. And if you take a look just in the purple there, that's one of the train system that's called the T line in Boston stops. So our lot is, you can touch the parking lot of the train station from our lot. You could not be any closer. I'm just really ecstatic about this location. If any of you have ever had the privilege of driving in Boston traffic, it's some of the worst in the US, so taking mass transit is super desirable. From an amenity standpoint, we've got, Target and Starbucks and pretty much everything that you would need all within a 1 mile radius. On the other side that you really can't see as well, lots of employment opportunities. So it's a really, really good location. It's a beautiful looking product. It should be around a 20% IRR on this one. So Darren's asking, is this going to be part of Fund 9? Yes, and it is not broken ground yet. It's fully entitled and shovel ready. I think they're going to start in first quarter of next year. Great project. So the Meadows project really goes with the one before, Spring Forest. Same sponsor and very similar geographic location in North Carolina. This is a smaller asset, about 68 units, completed in 2023. Similar situation where the seller got into a bind and needed to sell on relatively short notice. I think they probably had a loan that was maturing and they weren't excited about the options that they had for rates. I'm just guessing. I think that's what it was. Anyway, this was 97% occupied when we took it over. We've got a couple value add ideas, but it shouldn't take a lot. So this is just another easy project that should be pretty low risk. Good looking on the inside, very modern. So the Travis, you want to talk about this one?
Yeah, as we're going through these one by one, Lon, it's so impressive, I think, so far about investing in this down market and the opportunities that we've been finding is being able to acquire a lot of these properties at a very favorable basis. And
it's a great time to be a buyer. It's incredible.
Travis is just another example of that. This is a new sponsor for us. So it's a 2020 new Class A apartment complex and a just phenomenal location in downtown Houston. The sponsor we're working with on this project, they've got nearly $2 billion portfolio, 20 communities, over 5,000 units. If you look at their track record, a lot of what they have accomplished, they've been hitting project IRRs above 25%. So just a sponsor that's got a phenomenal track record, which is everything that we look for when we're allocating your capital. Our sponsors who have at least 4 to 5 full cycle deals, and this sponsor is just another one that matches that very well. I think what's really unique and interesting about this is it was a sale. What had happened was the former developer had to sell the project. They were way over budget on construction. They weren't necessarily hitting their pro forma, and they had to reallocate and redeploy capital elsewhere. So they were kind of under the gun to try to sell this project. And we bought this project nearly 50% or lower than the replacement cost. So you're buying a Class AA apartment complex. The renovations are pretty much completed, and you're getting a phenomenal Class A asset and a phenomenal location for $89,000 a door. If you're to go build this in that same location, you'd spend north.
It might be a little bit more though. It was 89 million versus 208 million. I think the per door
sorry.
Sorry about that. Yeah, that's right.
Below 50% replacement costs. So if you're going to go build this today, you're going to build this for probably $200+ million when you can buy it at nearly $89 million. So phenomenal basis. And when you have such good basis like that, it's hard to lose on an investment like that. So for this project, we're projecting about 19% to you guys net for this project over about a 4 to 5 year period. We will be investing $750,000 in this project. So really excited for this one. Fantastic basis, low basis, and an A+ location. You can't ask for much more than that.
So here's some photos.
Yeah, so you can clearly see phenomenal, just glass exterior. You can see the pool there on above the parking garage, pool common area, some of the clubhouse. So just a really well done property.
It's right on a light rail stop. It's just outside of downtown. It's actually between downtown and the medical center, and you go to light rail that connects those two, and this is like smack in the middle of it. It's I'm very grateful we're part of it. Cool. So the Phoenix Warehouse, the sponsor here is Provident, who I've invested with a number of times, and they've generated quite a lot of home runs for us in the past. I don't think this will be a home run. I think this is just going to be like a double. but that's still fantastic. This is in Phoenix. Should be about a 3-year construction for this industrial project. And what's nice about this is that it's in Glendale, Arizona, which is pretty much fully built out because it's pretty close to central Arizona. There hasn't been a warehouse built here in over 20 years just because there's no land really that's left to be able to do it. So I'll show you really quickly here. If you take a look on the upper left, that star is the location of our project. And central Phoenix, if you just go a little bit down, we see kind of those really dark orange hexagons. That's the main industrial and manufacturing sector within Phoenix. Most of the new construction is in the upper left where it's almost white because that's where all the land is available. So we're building close in to where all the activity is at, and there's no new construction to speak of at all in this area. So we anticipate it's going to be taken up pretty quickly. Another nice thing about this is that it's not a huge warehouse, 300,000 square feet, as opposed to like a typical Amazon class warehouse would be a little bit over 1 million square feet. We've got the ability to subdivide this 300,000 feet. We could give it just to one tenant if that's what we get, or if we want to slice it up to 3 tenants or 5 tenants or 6 tenants, it's laid out that we can subdivide it. And there's very little available for these 40,000 or 20,000 square foot users out there. So I suspect that we'll get this thing rented out pretty rapidly. Be my preference to get one large tenant who's like a famous name that'll help us get a better price. So we've already broken ground on it. You can see those photos are about a month old, but they're getting all the site prep out of the way. So Randy's asking, if I invest in this, could I use the funds in this fund to cover capital calls for other funds? You can't. So this is there's no liquidity to this one, but if you have some extra cash that you want to just kind of keep available for capital calls or any other cash requirements you or your business may have, the short-term income fund would be a really good match for that. Okay, the New Jersey townhome. So this is in Jersey City. Let me just see if I can show you a map. So if you take a look in the upper left, you can see there's a PATH train logo in Grove Station. And I believe that we're 8 or 12 minutes away from that station. And that train goes underneath the Hudson River and it shows up in the financial district of Manhattan. It's like less than 20 minutes. It's actually faster to commute from Jersey City to the financial center like Wall Street than it is to, say, from the Upper East Side. So very privileged location. This has a walk score that's like an 89. So lots of things you can walk to from the site. Beautiful finishes. It's going to be really, really nice. So this photo here is a picture of a project that the same sponsor built. It's literally across the street from the one that we're going to be investing in. And very tall ceilings, really good glass, very high quality sound installation. It's very quiet on the inside, good amenities, just well thought out. Everything about it was very impressive. They got the same architectural team, same general contractor to build our project. Yeah, this is an existing neighborhood. So the site that we've got was an old warehouse for an electrical contractor, if I remember correctly. So the father died. Mom's probably in a nursing home at this point. The kids just said dump it. So they got it for actually less than what the dad wanted it for. So they just wanted a quick sale. So one of the things that's interesting about this is that they're going through the entitlement process with the city, and they're almost done with that. And there's a hypothesis that they might be able to make the majority of the profit of the project just selling the first level of the plans and the new permits and the zoning being where it needs to be. Maybe sell this thing in a year and get the vast majority of the profits just be out of it. So we may build it, we might just flip the land, but either way, the returns will be very attractive for us. Here's some photos from that project across the street. They're going to do basically the same design package. It was really nice. I walked through a lot of new construction. This was better than typical by quite a bit. Okay, moving back to Denver, here is single track residential. We're going to be building 4 for sale units. So it's 2 duplexes in central Denver. And the price point on these should be pretty easy for us to sell these, and it should be about a 16 IRR. So we're gonna put about 300,000 into this. Should be relatively low risk, pretty easy project. Our pro forma, to be conservative, we didn't assume any appreciation. We took the current comps and we knocked it down by 5% just in case there's a small price correction. I don't think there is going to be a price correction, but just in case there is, that's what I set our business case at. If the prices are flat, or if the prices historically over the last 50 years, prices have gone up a little bit over 6% per year in Denver. If that were to happen, which I think is also unlikely, this is in a 16 IRR, it's something in the 20s. So we're trying to be really conservative on our numbers with this. And if you're curious, you can download this to take a look at all the floor plans and stuff. Nick, do you want to do NPL or should I do it?
Can you do it?
Yep,
Can you do a
absolutely.
little bit more about it? Yep.
So this is Constitution Lending, which I think I may have got a typo in the heading there. Sorry about that. These guys have developed an AI engine that scrapes all of the judicial filings for every court in Connecticut to identify patterns of pre-foreclosure activity. And from that, they get the bank, the attorney that's doing the pre-filing, and then everything about the borrower and why they're in default and how badly in default they are. So they get this in almost real time. Every morning they come into the office, they've got a list of here's the new pre-foreclosure opportunities on the commercial side. And then they've got an engine to be able to figure out a valuation, and then they can compare what might we be able to buy this for, what is it worth, how much upside is there, and then they can kind of rank the opportunities each day that pop up. What's particularly beneficial about this sponsor is that they own a large property management company in Connecticut, which is not that big, and they've got their own maintenance and renovation guys as well as the leasing agents and maintenance people. So they can usually find someone in common at the building and find out what's going on operationally, find out what went wrong. Is it something that we can fix or not before they even get on the phone to the attorney to figure out, should we try to negotiate to buy this thing before it even hits the market or not? If it turns out it's just incompetent management and they're not responsive and the tenants are ticked off and they're not paying, then what they'll try to do is they'll go, and they've got a lot of experience doing this. They've done this for quite a while. They'll go to the bank. And typically, if it's an attractive deal with, they'll just say, so we're going to pay par. What that means is that, the mortgage is $1 million and there's $50,000 of back due interest and there's $25,000 of attorney's fees and other fees. We're going to pay par. We're going to pay $1,075,000 in exchange for us taking this off your hands because it's bad from a regulatory standpoint. The bank looks bad to the regulators if they've got this non-performing asset on their books. We'll pay par, so you don't have to take a write down. In exchange, we'd like for you to finance our purchase at say 85% or something like that. Or maybe finance us at 80%, but also give us a construction budget to fix whatever deferred maintenance needs to be done on here. And that's what these guys are doing. And they're just cherry picking these intermediate sized deals that are way too small to be attractive to an institutional fund, but they're generally speaking too big for a mom and pop investor. And a mom and pop isn't going to have invested in all the AI work they did to be able to find these things. Like no one's even seen these, so they're the only ones negotiating. So we're going to start out with $350,000 on this strategy in Fund 9. We'll probably put some in Fund 10 and 11 as well. This will probably be like a 15-month window where we're going to be able to cherry pick these commercial assets at really good prices. But I'm very, very excited about these. These guys know Connecticut really well. It's not that big an area. They've got deep relationships all over the place, and I think they're going to do really well. So I've been looking for an opportunistic way to take advantage of the stress in the commercial market, and we finally found a really good partner for that.
Oh, we had a couple of questions roll in here. Mark's asking, what is your capital goal for NDF 9? So we'll look to raise between $5 and $5.5 million for NDF 9. And then Randy, are your hold times conservative?
Yeah. So, if you go back here, Randy, Hill Point, if I had to guess, I think it's probably more likely it's between 4.5 and 5 years, not 6. The DC Capital Flats guys, I don't know them well enough as a sponsor to know if 6 is too long or not. I suspect that's probably got a fair amount of padding in it. The Meadows project and the Spring Forest project, those are newer projects. They only need to require light rehab. We bought them at a discount because we had a distressed seller. There's a decent chance that could be a 2-year project if the market in 26 is really strong. Zero New Boston, that'll take all 4 years. That's not going to be any faster. The Phoenix warehouse, they broke ground like instantly on that. That'll probably be done in 12 months. That could be 2 years, but 3 years to be a safer bet. The Travis in Houston, I would say 4 just to be conservative. Could be faster. Some of these other ones are probably just about right. Florentine, yeah. So, yeah, we've sandbagged all these. All right. Capital Flats. So this
Oh,
is
wait,
Harrisburg.
sorry, Lon. Sorry,
Yeah.
we did have another question from Roger. Is this Denver investment similar to the Lowell single asset investment?
Oh, for the single track, the 2 duplexes?
Yeah. Yep.
Yeah, it's a different builder. And for those of you guys that don't know, the Lowell project is 2 5-unit row homes close to a light rail stop. So it's a similar strategy. It's a type of product for which there's a lot of sales, so it should be pretty easy to move them, sell them when we're done.
Cool. And then Darren wanted to clarify again, wanted to make sure that I'm clear that you start returning upon some of these earlier closings in the fund. Is that correct?
Yeah. So when a sponsor, like let's say it's Hill Point, they get their first 4 projects into lease up and they refinance and they send, $800,000 back to us or something, we'll be sending you that capital as rapidly as we possibly can. We don't hold on to anything here. So the way to think about this is that all of our interests are really aligned. We get paid a bonus based on how high of an IRR we can find for you for each of these individual projects. So that's a function really of 2 things. It's how much profit can I generate for you and how rapidly can I do it? It's also assisted by if we can do a refinance and return capital to you quickly as opposed to making you wait, say, 5 years to get your capital back. If I can get most of it back in 2 years, that also really increases the IRR. So it's a win for both of us. So we have absolutely everything in common about trying to get capital back to you as quick as we can. Great question. So this is Harrisburg, Pennsylvania. If you're not familiar, which I'm not very familiar with Pennsylvania, that is the capital. So there's lots of legislatures and lobbyists and all the other things that you expect in a capital, and they're short of nice housing. So this particular was an office building, is in a really nice location. So the bank that owned the office building, it had been vacant for a while, so they bought it for, I can't remember what, $35 a foot. It was something just asinine. How cheap this building was. And it's a really nice building. It's like all concrete. So if you're not familiar, if you can have concrete floors, concrete absorbs sound better than just about anything. So there's almost no sound transmission. So you can have a guy on the 3rd floor have a stereo on pretty loud, and the person on the 2nd floor probably won't even be able to hear it. So it's a very pleasant building to live in, and you don't have tenant turnover because of noisy neighbors, because the construction is so solid on it. So this is going to get converted from office to apartments, and we're pretty bullish on the math on this. We did put a 6-year on this. I think that it's likely it's going to go quite a lot faster than that, but it's hard to know. So we put that in there.
Lon, one of the questions that comes to mind, and you kind of already answered it without being asked it, but what makes office to multifamily conversion so challenging is how expensive the projects are. So you have to get these projects at an unbelievably low basis, or maybe the city or state provides grants to reposition a lot of these assets, which is not happening here. So when you're getting something for $35 a foot, you can actually capitalize on a reposition of this nature, which is very hard to accomplish in like probably 9 out of 10 circumstances. So I think that's what really makes this project work, is if you can get something for $35 a foot, repositioning it should create a lot of upside, but it also makes the project really work well by getting it at such a low basis. Yeah. We got a question from Katie. Would this investment work for a 721 exchange?
No, this wouldn't, unfortunately, but we've got some other tax management strategies that might be interesting. So Nick can definitely follow up with you on that, Katie.
And then
Roger was asking about stabilization. Were you thinking about just for capital flats, Roger, or for one of the other ones? We'll give him a minute to type the response in for that.
might be looking. You might be thinking
For this one?
Yeah.
Yeah, so stabilization on this, I would anticipate they'll probably have most of the construction done by 24 months, if not sooner. And it's only 79 units, so it'll probably take 6 months to lease up. So I'd hope that they've got, stabilized cash flow by month 30-ish. So you'll maybe have 6 months of track record by month 36. So you could either do a refinance or it might be a candidate to start looking at selling at that point. These guys put in 6 years. They gave themselves a lot of sandbagging on this one. Here's a couple other photos on the outside of it. Do you want to do Verico?
Yeah, absolutely. So I got to see the Florentine a couple months ago, actually. And this is so for those unfamiliar with Verico, Terrence Doyle, founder of the company, we've worked with him on many projects. We've got a 34 unit up in Westminster, Colorado, that's on the market to sell right now after post renovation and stabilization. It only took 11 months to complete. That's on the market right now. We've got another single asset fund, Verico Fund 2, which maybe some of you on here might be a part of. We had launched that last year. They made 30 investments in that fund and they've sold 10 of them. They ended up recycling a lot of that capital, but some of the IRRs they're achieving in a short period of time in that fund are north of 50%. So really high, but also 1-year timelines in that fund. So, I mentioned all that because we've got a really good working relationship with Verico. They are highly skilled at finding great basis opportunities at pretty favorable financing. And on this particular project, so it's a workforce housing. It's going to be a multifamily value add project. So a project they've done dozens and dozens of times. This is their first foray into Omaha, Nebraska. So they've traditionally been very heavy in Denver and in Des Moines, Iowa, and in some of the tertiary markets within Iowa. But they're expanding into Omaha, Nebraska. And for those unfamiliar with Omaha, it's kind of a market that's under the radar. One of the largest MSAs in the Midwest, and people don't even really realize it. So you've got north of 1 million people in the Omaha MSA. It's a fantastic market, and there's a lot of opportunity to acquire some of these multifamily value add deals from owners who are just somewhat in distress and haven't done any work to the project in nearly a couple decades. So the strategy here is to go in, renovate, and reposition 174 unit property. The goal here is to bring the rents up about $150 to $250 per unit. I think what's particularly attractive here is they've come in, they've acquired it, but they have already realized a lot of these rental increases without even touching the units. So it's always a good sign when you can come in, increase the rent just by putting in better property management without adding to your basis from the start. And so that's what we really like about this project. And we look at it from a basis standpoint. Again, a lot of the investments we've looked at here have just had fantastic basis where we've been able to acquire some of these assets much lower than what some of the neighboring comps have sold at, even in the last year in a down market. So when we look at this, we bought it at 95% occupancy. So the goal here is to invest about $10,000 per unit. Again, that might go up, maybe more likely to go down. I think we might not even need to spend a lot of that just for through the rent bumps that we've already realized by coming in and, again, putting in the in-house vertically integrated property management team. When we acquired this, the expense ratio was around 70%. So the owner was just, he was piling money into repairs and maintenance. It's an older asset from the 1970s. He hasn't really taken care of it. And so he's just been funneling. It's been a money pit for the owner, and that's why his expense ratio is so high. So not only are we going to realize the rent bumps, we're also going to be able to increase the NOI just by bringing down the expense ratio. And likely through our in-house property management team, we'll bring that expense ratio down from 70 to 40% and realize a ton of forced appreciation just by doing that alone. Some of the units we will add washers and dryers. That's what is likely to contribute to some of those rent bumps. What we've been seeing is the rent bumps from the adding washers and dryers is between 200 to 250. And so if we're able to renovate the units even more, modernize them quite a bit to a point that's above the Class C and B minus product, but slightly below the Class A product, we'll likely be able to realize much more rent growth than we originally anticipated. And going back to the basis here, so we're buying this asset, we bought this asset at $65,000 a door, which is nearly $40,000 a door below what the other classic type value add projects have been trading at, even in 2023 and 2024. So to see that we're able to get something at $65,000 a door, and you're already seeing stuff that's in the same condition trading at $100,000 per door says a lot. And in the underwriting, Verico, we've taken a look at it. Even on the exit, so when we modernize the units, renovate them, add the washer and dryer, bring in a better property management company, lower the expense ratio, we are estimating to sell this at $105,000 a door. So we're talking about releasing a product into the market that is a step above the other product, and we're planning to try to sell it at exactly what the original comp sold at in the last 2 years. So, again, I don't want to say, that there's obviously no guarantee, but when you look at something that you can buy at such a fantastic basis, especially with an operator like Verico, it's hard to lose. And on top of that, where the interest rate environment is today, if you're not going to assume agency financing and you're going to go out and get new debt on a project like this, you're probably going to spend 6.5%, 7%, maybe even more if you need to get a bridge loan temporarily to get it to stabilization, in which case you're at 8 to 8.5%. In this case, we're buying something with just strong cash flow right from the start, primarily driven through the assumable agency financing that we're getting. So we're assuming agency financing at 3.2%, and we still have 7 years left on the loan. So we've got a lot of flexibility here with what we want to do. And while we try to realize some of those rent bumps without putting a lot of renovations in, we've got just fantastic basis and cash flow going into this project. So I got to tour a lot of the other units that are comparables. A lot of the other comparables in the market are in a very similar condition, rented at a much higher price, and they haven't been touched in a while. So I feel very good about this project. I'm sure we'll be out to see it again, and I'm excited to see what Verico does in Omaha. This will probably be the first of many transactions for them in this market.
Yeah, I'm pretty optimistic about this one.
Yeah.
Great summary on that.
Yeah, so here's some pictures. They weren't in terrible condition, but you can see there's the dog park. That actually used to be a swimming pool, but they changed that. There's a lot of green space here, common areas. A lot of the units were really, honestly, in good condition. That's why there's not so much of a need for renovating the interiors. They're not in a lot of distress. They're pretty well maintained, given the age of the product. Lon, I'm going to turn this one over to you. This is an exciting new addition.
Yeah, I think this is our last one in our fund here. So we're going to have a third opportunity fund. So this is a sponsor, Lorin, that we've worked with quite a bit in the past. We've got a great relationship with them. And they've got a situation where they need to do a capital call. They've completed the renovation at these 3 projects. They've been able to raise the rent. So that sort of risk is off the table now. On like a 5-year project, they're either 2.5 or 3 years into it. The interest rate for this, of course, is much higher than anybody anticipated when they underwrote the deal. They had locks on the rates that were good for 2 or 3 years, depending on the project, but those locks have expired. So now you've got you're paying 9% or something insane. So they've got the improved cash flow from raising the rents and completing the renovation, but they need to get some amount of seasoning before they can do the refinance, and they don't have enough cash to make it all the way to the finish line. So the sponsor has done a capital call. Most of the people in the fund have made their capital call, but not all of them have. So for those of you guys who are in Opportunity Fund 1 or Opportunity Fund 2, it's the exact same strategy, just 3 different assets. Otherwise, it's all the same. So the way the organizational documents are written for this sponsor is that if you're requested to make a capital call and you don't do it, when the project is wrapped up, you'll get your capital back, but you basically give up most of your profit. And the guy who steps in to fund the capital call for you gets their pro rata share of the profit plus yours that you sacrificed because you didn't answer the capital call. So basically, the person who steps in midway through the project gets a double dip on the profits, not a single dip. And we're only going to be in the project for, say, 24 or 30 months as opposed to 60 months. The other thing the sponsor is doing to induce us to help with this is that they're not taking their usual fees or profit split on the incremental capital that they're raising. So we've got all these really amazing factors that are helping out quite a bit to improve the economics. So this is something in the range of like a 35% IRR. So let me show you a little bit on how that works. Oh, briefly on Lorin. So 16,000 apartment units, 68 units, complex is renovated, $3.5 billion in assets, and of the 20 full life cycle projects they've completed, a 28% IRR. So I mean, these are really experienced guys. So take a look on the left part of this. This is a typical project, and we'll look at the 36-month exit. So from your point of view as an investor, a limited partner with us, you'd be putting 100,000 in to the strategy. And let's say that you're going to be in it for 60 months. So you invested 2.5 years ago. And when the project is wrapped up, you're going to get your 100 grand back plus 140,000 of profit. Yes, this opportunity fund will be part of Fund 9. We've got a small amount we can put in. So that's a 19% rate of return for you as a limited partner. So that's our baseline. So the initial investors in the project, they thought they were going to get a 19. So what happens if the sponsor doesn't take a cut of the profits? Well, instead of getting 240,000, you get 280,000. So now your IRR is going to be a 23% per year. What if we change the start date? So you see that the initial investors came in on, say, January 15th of 22. We're going to come in on January 15th of 25. So we're knocking 3 years off the project. That changes it from a 23% to a 39%. Just the fact that your money is out for such a short period of time almost doubles the rate of return. And then what if you get to take 70% of the profit of the person who didn't fund the capital call? So you're getting almost a 2x on the profit. Then it ends up being a 53% IRR. So that's why the returns on this are so attractive. It's just the way the documents are written. If it takes 48 months, then it'd be like a 35. So I'm setting expectations that it's going to be a 4-year project and a 35 IRR. We're optimistic that it could be faster than that. So I think you've already answered those questions. So let me show you the 3 projects that are going to be in ICO 3, and we're going to be putting, I think it's going to be about $500,000 out of NDF 9 will be invested into the ICO strategy. And you won't be paying the fees twice, you just pay the fees once. So Atrium, we invested in this project in Fund 5. This is like a build to rent. So it's basically a community of about 114 duplexes. I guess it's 70 some buildings. So what's great about this is usually if you're a renter, you're parking and then you got to load up all your groceries and your kid and walk across the parking lot up 3 flights of stairs to put your groceries away. Then when you got to take your dog out, you got to put your clothes back on and go downstairs, let out the dog, and go back up. It's kind of a pain. It's nice to be a renter and have your own garage you pull into. And if it's raining out, you can unload your groceries without getting wet. And you've got a backyard that's your own backyard that's fenced in for your dog and your kid. This is a really desirable rental product, and it's in a really fantastic market. So we invested this in Fund 5, and we're going to provide a little bit of additional capital for their capital call in Fund 9 and in ICO 3. And there's a small possibility we might be able to sell this thing next year. If that happens, it's going to be really attractive, but I wouldn't bet on it. Plan for the 4-year project.
We have a couple of questions that rolled in here, Lon.
Yep.
So to answer Darren's question, no, it's not a standalone opportunity. This is part of NDF 9. So everything that is presented here, you as an investor will have access to. Your money will be allocated appropriately to every fund here, or to every opportunity here. So Randy's question, expected capital calls on IO3. Not sure.
Well, there shouldn't be any. So like Atrium, for example, the one we're looking at right now, has a capital call currently, and they're finding out probably next week which of their current LPs are making their funding of a capital call versus who is not. And whoever is not, we'll write a check for that. And that'll be part of either our Opportunity Fund 3 or our Fund 9. So we're going to step in and do this. We know this project. We love it. It's a fabulous project.
Another great question here from Mark that we've been asked before. Are the NDF 9 docs written the same way? So if an investor does not meet the capital call in NDF 9, does the investor lose all profit?
No, we're not written that way. So we would hope that you would fund your capital call, but there's no economic penalty if you don't. I think it's a good way to piss off your limited partner and never have them work with you ever again. So it's just, I don't know, it's kind of a silly way to write a set of documents to me. I'm a lot of you guys are in the real estate business, and your business is based on repeat and referral clients. And my business is based on repeat and referral, just like yours is. And if I take you guys off, I'm not going to have a business for very long. Okay.
Brian's asking, have you had capital calls on other NDFs, and what have those looked like?
Yeah, we have. So we've had a couple in the first 4 funds. I think there was like 1 capital call per fund. Fund 5, I think it was, had a capital call, and we had some extra cash sitting on the side, and we funded it out of the cash reserves that we had. And then I can't remember if it was Fund 7 or Fund 8. It'll be in the notes. I apologize, but we had 2 other ones where there was a capital call. It wasn't very much. It's like on a $10 million fund, it was like a $120,000 capital call. So we just borrowed the money and we paid it for you. And then when we get some cash out of the project, the first thing we'll do is pay back the loan, so that we didn't have to bother all you guys to send in a check for like, $1,100, which would be kind of a nuisance.
Yeah, and to reiterate, this is why we now have the PFD investment as part of every fund. Before we just raised, we had the contingency that would cover that, but now we have the PFD follow-on investment within each NDF that will cover that. So we should hopefully, never have to come to you guys for more money if that does arise.
And then for Roger, the Ironton Opportunity Fund 3, ICO3, is a brand new fund just right now. So one of the investments in ICO3 is doing the capital call for Atrium. The initial investment in Atrium, that's in Fund 5. So it's a project that we've known really well for quite a while. Mark was asking about how much of a capital call for each investor. I want to say it was roughly around 10%. So I think the earlier projects that we had with Loren, where we had a capital call, we invested about $1 million, and our capital call is like 100 or 120,000. So it's in the 10% range. So that's the reason why we're now putting, like in this fund, I think it's like a couple $100,000 into the cash account at the medium-term income fund and leaving it there for a couple of years, so that if we get a capital call, I don't have to go borrow money from someone. I'll just have the capital already here, and I can just write the capital call out of that. Didn't occur to me on Fund 5 to do that. I wish it would have, but get better every fund. I don't want to send a request out to capital to you guys if I don't have to. So, Nick, I think that you've been to see the Fitzroy project in Northwest Arkansas, and Palisades is across the street. Would you be able to talk about maybe Northwest Arkansas in general and maybe that location in particular? And then I'll talk a little bit about Palisade.
Yeah, absolutely. So we invested in a project owned by the sponsor called the Fitzroy. That was in NDF 6 and 7. I believe we invested $1 million into that project spread across both funds. So for those unfamiliar with Northwest Arkansas, it's probably one of the most undervalued high growth markets in the United States. I mean, there's a ton of growth from a rental standpoint, from a population standpoint. Just recently, U-Haul, van lines, they released these reports, and they, that says, where is everybody moving? And the number one net positive migration state in the United States is Arkansas, mostly going into the Northwest Arkansas region. So there's a ton of investment and opportunity coming into that market. Loren, in this case, they own the Fitzroy. And then this asset, you could literally throw a stone and hit probably the clubhouse from the Fitzroy. So it is literally right across the street. And it's a project that they've owned, I believe it's since 2019 or built in 2017. And I believe they acquired it in 2020 as a Class A apartment complex.
Yep.
So it's right across the street. And why this is important is Loren's got economies of scale in this market. So if somebody doesn't want to live in the Fitzroy, or if they want to move out of the Palisades, they can go across the street and move their stuff to the Fitzroy, or vice versa. So they've got a lot of economies of scale. It's a fantastic market, and they've got a strong position in this market that can really help them, to perform on these assets. So that's an overview of the location of Northwest Arkansas and where this project is specifically.
So something nice about the greater Bentonville area is that it's the home of 3 Fortune 500 companies: Tyson Foods, the Chicken Giant, JB Hunt. So you probably see their semi trucks on the interstate all the time, and then of course Walmart with all their suppliers are all based there. So for a small town, it's incredible to have 3 companies like that. And Maddox is also in that same market. It's just a couple miles down the road, if I remember correctly. Exact same situation as the other 2. So same strategy, everything else. So I'm underwriting this from the point of view that, like Maddox, for example, it was a 5-year business plan. We're buying in with our capital call at month 32 of a 60-month project. So we're more than halfway. The renovations are done. The rents have been increased. We're just on a glide path to the end of it. So this has got like 2.5 years to go on the business plan. And I put in here, I think, 4 years just to be conservative. But this has got a lot of upside. I'm pretty excited about the project. And that's it for the 13 investments. So this page will look very familiar to you if you've invested with us before, because very little has changed. The target net return, I'm going to publish it at 17 to 20. At the moment, it's actually in reality a little higher than that. Term of 4 to 6 years with some extensions if we need it. The preferred return is 8% if you're in Class A. Do you want to talk about how that works?
Yeah. So if you're in Class A, there's a preferred return that we owe you investors. Your return is preferred over ours in that first tier of the waterfall. So if you're in the Class A, you get 8%. If you're in Class B, you get 5%, and you're going to get 100% of the cash flow up until that point. Now, likely the preferred return will not be paid out until we actually can sell a lot of these assets, at which point there's a profit to be made on that investment. So I wouldn't anticipate that you're going to get a pref paid out in years 1 and 2. Likely what's to happen when we distribute capital and we sell some of the investments, that's really when the preferred return is going to start to pay out. So you'll get 100% of the profits from 0 to 8% if you're Class A. If you're Class B, it's 0 to 5%. And then the second tier is if you go from 8, up from there, the next tier is you get 72% of the profit as a limited partner from the preferred return all the way up to a 20% IRR. And if we perform better than a 20%, all the way up to a 30% IRR, it's a 70-30 split in favor of the limited partner. And then 30% and up, it's a 60-40 split. So, you can clearly see that we're highly incentivized to find only the best projects for you guys. Because not only do you make more money, but so do we. And so our interests are closely aligned in that regard.
Yep. And then there's a one-time acquisition fee and a annual management fee, and those are just flat fees. We used to charge that as a percentage. The Securities and Exchange Commission is encouraging all of us who run funds just to have a flat fee instead of a percentage. So we've made that change based on the SEC's guidance to us. And then if we do decide to do an annual audit from an external accountant of the fund's records, that would probably be $40,000 or $50,000. So if there's 90 of you guys, that'd be $550 per investor per year. We haven't decided if we're going to do that or not yet, but we'll obviously let you know. And I think that's it for the returns and expenses. And then there's a couple testimonials here about people who've enjoyed working with us. Can you tell a little bit about what's an accredited investor, Nick?
Yeah, do we have that coming up?
I think so.
Oh yeah, so an accredited investor is one of 3 criteria. If you have investable assets over $1 million, excluding your primary residence, you are an accredited investor. If you do not meet that threshold, you can qualify the income route, which is $300,000 or more as a dual income household, or $200,000 or more in a single household income. So we have a CPA form we can give you if you need to verify, or we have a third-party service you can utilize, and that will be good for 5 years if you go through that link. So if you have any questions about that, you can book a call with us, or you can reach out to me directly.
Perfect. So Roger was asking about how the fees change, so I'll answer that really quick. So Roger, if we raise 5.5 million, in the past we charged a 1% acquisition fee. So I just took 1% times 5.5 million, and that's where the 55,000 came from. And then the annual management fee was 2%. So 2% times a $5.5 million fund is 110,000. So I just made it match what it was before. I didn't increase it or decline it. I just kept it exactly the same. I just rewrote it the way the SEC told me to write it. Yeah, the fees are, it's 3% the first year and it's 2% a year after that. And that basically gets us to break even on the fund for paying for all the legal and other stuff we've got to pay for. Really all the profits on are the carried interest line. So this is an important thing. So if you have a stockbroker helping you pick stocks and bonds, there's something called discretion where you can give them the authority to pick the stocks and buy them or sell them when they see fit without your intervention if you choose to delegate that responsibility to them. That's called discretion. I do not have discretion with your money and I don't want discretion. So you're going to see in the contract documents to work with us that we've got a very specific list of what we are allowed to invest in. It's pretty specific. So all of the things we've talked about in here match those criteria. And then when we finalize the investment portfolio, and at this point we're like, this is probably 99% final. We'll do one last webinar saying, here's the final list, and we're going to give it to you in writing. And if there's any variations of what we invested in versus what the fund document said we could invest in, we'll highlight that for you and explain why the variance is. And then you'll have 10 days to study that with your CPA and your financial planner and your attorney. And if for any reason you're not happy with the portfolio we picked, let us know. You'll get your money back and we'll just tear up the contract. You and I are going to be working together for the next 4 or more likely 6 years. And I want you to be just as enthusiastic as I am about all the stuff I picked out. And if you're not enthusiastic, then there's no reason for us to be miserable together. I'm just happy to give you your money back. It's no problem. So, and we don't reinvest any of the cash. So when the cash comes in from a successful project, we give it back to you. We don't reinvest it for you. And then you're surprised by what we picked. I don't want there to be any surprises.
A couple more questions here. Yes, Brian, important point to note there. The returns are that we're presenting and projecting to you guys are net of fees.
Yes.
So the gross IRR is high, like much higher than the 17 to 20%, but the 17 to 20% is your net take home pre-tax.
Yeah, our target gross return somewhere in the 24, 26 range. Yeah. So with the expenses to run the fund and hopefully some profit share for us, you guys ought to net somewhere in the 17 to 20% range after all the expenses.
Well, I apologize. Did you already answer Kurt's question there?
Do you have language? Oh yeah. So Kurt, there's 3 main strategies in real estate. So you could buy something nice and pay a high price, and it just generates cash and you hold it for a long time. So it's like a bond. We don't do any of that strategy. The dominant way to buy that type, like a large shopping mall or a huge apartment building, is you buy what's called a REIT, a real estate investment trust. And most REITs are specialized on a particular asset class, and sometimes an asset class in a geography. So if you just want to have A-class apartments in the Midwest, I'm sure there's a REIT that specializes just in that. The next of the 3 strategies is you could buy something that's beat up in terrible condition at a discount, put in a lot of money, raise the rents, and like a fix and flip, but just for a commercial building. That's about half of what we do. REITs almost never do that. REITs want to buy pretty stuff and pay a lot and then have no work and no risk, or as little risk as possible. And then the third strategy is you could build something from scratch. And we love doing that type of work as well. And that's also very not compatible with REITs. So there's pros and cons to each type of structure. So if you get a REIT, what's really great about that is that many REITs are traded on stock exchanges. So there's liquidity. They pick a NAV, a net asset value. It's calculated pretty much every day, just like Apple stock. So if you want to sell your position in a REIT, you could sell it and you'll have your cash like 3 days later. So liquidity is one huge advantage of a REIT versus us. Another advantage of a REIT is that it's tax preferred in the method of distribution as long as the REIT is run correctly. And believe me, if you're running $1 billion REIT, you're going to have an accountant make sure you dot every I exactly the right way. So for most investors, the distributions coming out of a REIT will be taxed at about 20% at the federal level. And you'll talk to your CPA, of course. I'm not a CPA, I can't give financial advice, but for most of you, it'd be about a 20% rate. So if you're a relatively high income earner, your marginal income rate might be 35%. So to have your income from your REIT taxed at 20, almost cut your tax bill in half. So that's another very powerful advantage of a REIT that we don't have with our fund. A big disadvantage of a REIT is you're not allowed to distribute any losses. You can't distribute any depreciation, whereas we are allowed to distribute that out to you. So that's one powerful advantage of what we do. So for REITs, where they tend to be most helpful is if you want some real estate exposure in an asset class where you're going to pay a high price for a beautiful asset that's performing really well, and maybe you make like a 6% yield and there's not a lot of appreciation. If that fits your risk profile, because it's lower risk than us and it's really liquid, REITs are a really good example of a type of investment. We don't try to compete with them because it's a very scale economy play. So if you're not like $1 billion fund, you just can't be competitive at it. We like to work on the high value added projects where we can make somewhere in the 17 to 20% a year range. So our returns on average should be about double what you'll find in a REIT. So after you look at a tax standpoint, most of our gains are going to be distributed to you as capital gains, which for most of you will be on a federal level around 20%. So the tax treatment, again, talk to your CPA. I'm not a tax planner. For most of you, your tax impact with us will be relatively similar to the REIT. That's a very long answer to a short question. If you've got more questions about that, I'd be happy to jump on a call with you and try to help you sort through all that. So the depreciation. So there's two share classes. The A share class gets a little higher return, but it gets no depreciation. So many of you guys are using a self-directed IRA or a Roth IRA. You don't need any depreciation in an IRA. So the A share class with the higher pref is talk to your CPA. Most likely, that's going to be a really good fit for you. On the other hand, the B share class gets a slightly lower pref, and it takes all of the depreciation. So if you currently own a rental property that you're going to sell and you're going to have a capital gain, check with your tax advisor, but you should find that the depreciation we can give you from our Class B shares can be used to offset the capital gains from the rental property you just sold. So it gives you the same effect tax-wise as a 1031 exchange, but now you're going into a passive investment instead of an active. So if that's kind of your situation, either Nick or I'd be glad to jump on a call in, and we can model that for you and build a spreadsheet and show you the exact numbers for your situation. We love doing that.
Awesome. And Kurt,
Good questions, guys.
Yeah, if we are invested with an IRA, we won't realize capital gains that are taxed. Yeah, Kurt. So if you're in a Roth IRA, it's all tax-free gain. If you're in a traditional IRA, it's tax deferred, so you'll get taxed later on in life, whenever you're accessing that money. Brian, so
be the same as if you had bought Apple stock in your IRA. It'd be a similar sort of tax handling, most likely.
Brian, so is that any rental property you sell during the life of the fund?
This is a really important question for your CPA. So my understanding, and again, I'm not a tax guy, is that if you get extra depreciation, let's say it's in 2024, and you don't have a capital gain to use it up with, or a depreciation recapture from a sale to use it up with, you're allowed to roll that forward to future tax years. So that if you sell a property in, say, 2026, and that's got a capital gain and some depreciation recapture, the depreciation that you got in 2024 could probably be used to offset that. For sure, please talk to your CPA to figure out all the mechanics for your unique situation. But yes, I think you're going to find that we should be able to do that.
Tim, is there a minimum investment required? Tim, we'd like to see 50,000, but if you are wanting to diversify capital across multiple funds, we'll go as low as 25.
Well, great questions today. This is great.
We're Oh, Kurt, did you previously talk about the benefits of changing the IRA investment to a Roth IRA while in the fund?
We've got a whole webinar just on that because that's about a 30-minute discussion to really do a good job on. And I know Nick would be delighted to send that to you. And if any of the rest of you guys have a need for it, you can go to this irontoncapital.com/book now and set a time with Nick and or shoot him an email and he'll get you all the details on that.
Yeah,
But
Kurt,
yeah,
you can reach out to me.
It's a very powerful tax saving, and that's a good half-hour discussion. So that we've got a great recording on that, and then we can answer your questions after.
Yeah, Kurt, just reach out to me. I think you've got my email address already anyway, so I'll send you the information. And yes, Brian, you will get a copy of this presentation.
What a great group. This is fabulous.
Yeah. Lengthy discussion, but a great discussion. So.
Oh, yeah. Well, every question is a good one, so I'm glad we went through them all.
Awesome. Well, that is it, everybody. So if you have any questions beyond this, thanks for sticking around 20 minutes past the 7 o'clock time here. So if you have any questions, reach out to us. Head to the book now link right there, or feel free to call or text or email us individually, and we're happy to address any further questions you have from here on out.
Thanks, everybody. Sweet. Have a great night.
Yeah.
Thank you.